Hi friends, now I'm going to discuss the theory for your chapter 15, which is on startup finance. Maybe I'll first give a broad overview of the chapter and then we discuss on the specifics which are there. So what we are going to see in startup finances, we did discuss about startup from a valuation point of view in the valuation chapter. Here we are going to look at what is a startup, where is it going to get funding from, what are the various tools or sources available for funding a startup. They can fund from their personal sources. You have something called as a venture capital, you have something called as a peer-to-peer lending, or you have something called as your crowd financing. So multiple are angel investors, multiple options are there for a startup funding or startup financing. So that is what you will see in this chapter. And then I think in the later part of the chapter, you will also see something called as what is a unicorn, what is a decacorn, and discuss on something called a succession planning, or how is that being done in case of a family managed business or in case of a startup. Let's first understand what is a startup from the point of view of Startup India initiative. The Startup India initiative, based on that, what is the definition of a startup? Because there are certain benefits which will come to a startup as far as this definition is concerned. So the Startup India scheme was initiated by the government of India on 16th of January 2016. So this came in 2016, and there is a definition of a startup there. The definition says two major things. One, it should not cross 100 crore turnover, and it should not have crossed 10 years. That is, the startup should have been formed, the turnover should not have crossed 100 crores, and the life of the startup should not have been beyond 10 years from the date of its incorporation. Certain other rules is either it should be a private limited company or a registered partnership firm or a limited liability partnership. These are various ways in which a startup can be formed. The turnover for the startup should not exceed 100 crores. That's another important condition we have. Also, because we don't want entities to get benefit, that is, you are crossing this limit of 10 years or something, what organizations can do is they may try to split their business. So entities should not have been formed by splitting up or reconstruction of a business already in existence. So these things should not be done by a startup. Without this, the startup should have been formed, and obviously it should work towards some rare something which is rare in nature. It should work towards innovation, development, commercialization of a new product, process or service driven by technology or intellectual property. So innovation is the major crux of a startup. The additional condition is, moment you touch that 100 crore limit, you will cease to be a startup. Provided an entity shall cease to be a startup if your turnover crosses this 100 crores or you complete this 10 years limit. And for getting the tax benefits which are available for a startup, you should get a certification from the inter-ministerial board set up for such purpose. So Startup India scheme was announced by the government to provide certain benefits to the startup. Tax benefits are there. Major condition is simple: 100 crores of turnover and 10 years of life. That's the major condition. Should be a private limited company or a limited liability partnership or a registered partnership. Basically, it should not be a public limited company, and it should not have been formed by splitting up of or reconstruction of a business already in existence. What are the major reasons for sustainable development of startups in India? If you see India's context, startups have been increasing year on year. Some years back, there were very few unicorns. Now, every year, some or the other unicorns keep getting created. So, multiple unicorns are there in the country. Unicorn is basically a company or a startup whose value is more than 1 billion US dollar, approximately rupees 8,000 crore. So, many startups have been coming in because of multiple things. One is government support. The government support came through that startup scheme which is there. Pool of talent. In India, there are a lot of graduates who come. So basically, there is availability of skilled workforce in India. India's talent pool with millions of graduates contribute to startup growth by leveraging their knowledge and skills to start their own ventures. Cost effective workforce. What is cost effective workforce? Is India's cost structure is considered to be more effective as compared to other countries. the amount of salaries which are there in India, the amount of expenses which we incur in India is comparatively lower as compared to other countries. India is a young country with over 10 million people joining the workforce every year. Every year 1 crore people are joining the workforce. This is cost effective. So because of this, when you compare to other countries, cost of setting up and running a startup or a business is comparatively lower. Other things is the technology part and the internet part. If you see over the last few years, because of Reliance Jio coming in, you could see that every user is now having access to internet. Earlier, what used to happen is, before Reliance Jio came in, there used to be limitation on daily access of internet. But now everybody accesses around 1 GB of internet or 1.5 GB of internet per day. So increasing use of internet has helped because of the affordable telecom. It has helped a lot of companies to not only reach to metros, but go beyond metros, go to the other places, the rural areas. You're able to reach to multiple locations. So the startups, whatever product they are providing, it is helping them to expand their reach to multiple places. Technology has revolutionized business processes, enabling quick, simple and efficient data storage and recording. Indian startups are also focusing on artificial intelligence, AI. If you see in the current scheme of things, most important thing which is happening is, one is artificial intelligence. You see ChatGPT being in. So a lot of AI based tools are coming in, with which a lot of things which were being done manually are now getting automated. Also, when I started the chapter, I said there are multiple sources of funding a startup. So there are variety of funding options. One is your personal borrowing, which is family borrowing or going for a bank loan. These are called traditional sources. But newer opportunities have come called as angel investors or venture capitalists, seed funding stage investors. So multiple things are coming into country. That is, I have availability of skilled workforce, government is supporting it, technology is there, internet utility is going up, the workforce is more cost effective, and variety of funding options are there. Explain some of the sources for funding a startup, or what are some of the innovative ways of financing a startup. Non-banking financial sources are becoming popular to finance a startup. Discuss. Now, one thing is, though we say startups are increasing, but it's very difficult for them to get bank funding. Why it is very difficult for them to get bank funding is, a startup most of the times will be loss making in nature. So when you're loss making in nature, it is very difficult for you to get bank funds. So then where is the funding going to come from? The first source of funding is the promoter himself. He has to bring money from himself or his family and friends. Personal financing. It is important because most of the investors will not put money in a deal if they see promoter is not contributing money. So the first thing is, promoter has to contribute money. If he has saved money, he can contribute that into the startup, or he can take personal loans. He can take loan at his personal end, put that money in a startup, or use example credit cards. If you have some personal credit cards, somehow use that limit for funding your startup, or go with family and friends, the known people. So you are trying to get loans from them. Why are you taking loans from them? Because it is easily accessible and they will have a better comfort when they give a loan to you as compared to a bank, because bank would want you to show some profitability. As of now, if you see, majority of the startups are loss making in nature. Now, this is one part. The other part I can go is, I can go through some equity kind of sources if possible, where we have something called as venture capital or angel investors and all is there. And we have some the modern methods of funding. One is called peer-to-peer lending. What is peer-to-peer lending is, in this case, what is going to happen is, there are set of people, there are 10 startups or 20 startups or 20 companies, they form together. People come together and lend money to each other. So they are going to lend money to each other. They are going to support the other companies. Whoever is doing well, they may want to support the other company, and lending happens to this. So peer-to-peer is one startup, technically not a startup, but the group of people who come together and one person funds it to another people. Crowdfunding. Crowdfunding is raising money from large number of individuals, small money. You're going to raise small amount of capital from a large number of individuals. If you see in India's context, there are crowdfunding platforms available. There are also crowdfunding which happens in the form of donations also, or you can take it in the form of equity also, or you can take it in the form of loans also. Donations is, for example, if somebody is having some health issue and he wants to raise money to get his treatment done, there are crowdfunding platforms which are available where money can be raised. Here you are going to raise small amount of money from large number of individuals. It could be in the form of equity, it could be in the form of loan. Micro loans, what is micro loan is? Basically the amount is going to be very less. A small loan given by a single individual at normally a lower rate of interest. Then I have something called as vendor financing, purchasing order financing, and factoring accounts receivable. This is, all the three are related, technically related to either your customer or related to supplier. What is vendor financing is, I tell my supplier that I want your product, but I don't have money. So what supplier is saying, please take product from me. In this company lends money to its customer. The supplier says, I am giving you this product on a credit period. I'm giving you this product on a credit period. When I give a credit, indirectly I'm extending a loan to them. So creditor is one source of funding. Purchase order financing is, I've got a huge order. The order is for 100 crores, 200 crores, 500 crores or 50 crores. But I don't have the money to execute this order. So there are few companies who lend against a purchase order, who are going to lend money to us against a purchase order. Purchase order financing company often advance the required funds directly to the supplier, and in this process what will happen is the startup will be able to execute the order, they will be able to generate profit from the order, and a part of the profit will go to purchase order financing companies in the form of interest. Factoring accounts receivable, I have sold the product on credit, but I am not able to manage my business, so I am going to factor my accounts receivable. What is factoring of accounts receivable is, I am going to sell my accounts receivable and get the money immediately. So multiple ways of raising money for a startup. Bank funding is slightly on the difficult side. The reason for being on the difficult side is the startup is not making money. Because the startup is not making money, the banks are not really interested in funding a startup. So what are the options? Either put money from your personal sources, or take loans at the personal end and do the funding, or go for something called as your friends and family, or the contemporary sources or the newer sources like peer-to-peer lending or crowdfunding or micro loans, and customer or supplier related funding. Either supplier will give you loan, or against a purchase order some companies will give you a loan, or you sell your accounts receivable. These are some of the sources of funding a startup. We are going to discuss about them little bit in detail in later set of questions. What do you mean by pitch presentation in the context of a startup business? Explain the methods to approach a pitch presentation. Now, pitch presentation is something you would have seen for example, this there was a television show on the startup related funding. That is, you would have seen this in Sony channel. So where a lot of people were making a pitch for their products. So they'll be making a pitch for their products. There are a set of people who question them. There are, I think, some 5 investors there. They will keep questioning them. So the startup, whatever presentation they are doing there, that was called as a pitch presentation. In a practical world, it is normally for around 20 minutes of time, where I'm trying to explain the prospects of the company to make the investor interested in my company, so that he could ultimately invest in my startup. It's a short and brief presentation to investor explaining about the prospects of the company. It could be done either through face-to-face meeting or online meetings. Earlier it used to be primarily face-to-face meeting, but a lot of things have changed. Now, what are you going to cover in a pitch presentation? First is introduction. Introduction is basically trying to explain what the company is all about. It should be in such a way that it is able to attract the attention of the investors. Then explain the team members who are there. So whichever is the team is going to execute, because the success or the failure of the product or service will depend largely on the execution capability of the team. Then problem statement. What is the problem we are going to solve? The promoter should be able to explain the problem he is going to solve and the solutions emerging from it. He should try to explain that this is a real problem which is there in the marketplace and I am going to solve this problem. I am going to solve this problem. Other part is how are we going to market the product which is there? So marketing of the product, deeply interested in marketing so that the investor has to communicate the market size. Then talk about the financials of the company. What is financials? Is talk about the P&L and balance sheet. Brief projections. Financial projections will include income statement, CFS and balance sheet, cash flow statement and balance sheet. Do a financial projection and explain where the business is likely to head. Give an overall view on the competition which is there in the marketplace. That is, who are the competitors? How is our product unique as compared to the competitors? We'll also talk about if any past funding has been taken by us. What is the business model of the company? A lot of other things will be talked about. Okay, yeah, business model. The business model is basically the way in which the company is going to earn revenue. What is business model is? How are you going to earn revenue? That's a simple definition. Is a wide term denoting core aspects of business, including purpose, business process, target customer, offering, strategy, infrastructure. It's also beneficial to discuss the lifetime value of the customer and what should be the strategy to keep him glued to the product. Simple definition of a business model is how are we going to bring revenues? What is the revenue model of the company? Financing, if you have raised any money in the past, if you have done any raising of money in the past, explain what have you done with that money. And if you have not raised money, then also explain that what have you achieved with the minimum of funding which you have raised from your personal sources. What are the documents you have to prepare for financial presentation? Basically 3 documents. I talked about P&L, balance sheet and cash flow statement. So income statement is going to discuss how is the profit going to be generated. Cash flow statement is going to talk about the requirements of money, and balance sheet is going to explain the financial position. What are the modes of financing for startup? Are explain angel investors. Now, first, we have already seen what are the sources of financing a startup. Now, what are the modes of financing for startup? Both may look very similar, but the point is now, at least in new syllabus, what we are going to focus is getting clarity on every topic so that you're able to answer an MCQ. It is not just copy pasting what is there in your ICA study material. So first is bootstrapping. What is bootstrapping is if you are able to fund the startup, if you're able to fund the startup from the personal sources or from the operating revenues of the new company. That is, if you are able to build a company from your personal finances or from the operating revenues, that is basically called as a bootstrapped model, where you are not taking money from outside sources. No bank funding, no investor funding, no angel investors, nothing is being taken. What is angel investor is basically, Ratan Tata is an angel investor. These are set of people who invest in small startups. They invest in small startups. Angel investors invest in small startups or entrepreneurs. The capital angel investors, they may be providing a one-time investment which will help the company to kickstart, or it could be an ongoing infusion of money, which will, most of the times this angel investors could be known people, Angel investors are also called informal investors. They could be among the entrepreneurs, family and friends. Sometimes you can also invest through crowdfunding platforms which are there. The angel investors may invest their money through the crowdfunding platforms. Now also, if you want to invest in a startup, there are options available. You just search invest in startup. You will find certain platforms where you also can invest money. What is venture capital fund? Now, venture capital fund is basically a fund which is pooling money from lot of sources. It is pooling money from multiple sources. Multiple investors pool their money together into a venture capital fund, and this fund invests in a lot of young, rapidly growing companies. They invest in young, rapidly growing companies that have the potential to develop into significant economic contributors. You are going to invest in those companies which are kind of extremely risky today, but with an objective that you'll be able to generate high returns, or you'll be able to generate multifold returns from your investment. Define angel investors. Are these only individuals? So angel investor are basically people who invest in small startups or entrepreneurs. They are mostly from your entrepreneurs, family and friends. Normally, angel investors would mean only individual, but the structuring of an angel investment can also be as a limited liability company or a trust or an investment fund. So there are multiple ways of listing it. It is not that it has to be only individual. It is not that it has to be only individual. Now, venture capital financing is another form of funding for a startup. VC funding, we call it as VC funding, venture capital funding. Angel investor is a single person. Normally, he invests in multiple startups. Venture capital funding, what happens is there is a VC fund. There is a fund which is created. This fund pools money like a mutual fund, A venture capital is going to pool money from a lot of investors, and then it is going to invest in a lot of high risk companies and a lot of startup. Venture capital means funds made available for startup and small business with exceptional growth potential. Venture capital is money provided by professionals. This is money which is being given by professionals who alongside management invest in young, rapidly growing companies that have potential to develop into significant economic contributors. You are trying to find companies which can grow at a very rapid rate. It can become 10x of what is today or 20x of what is today. So they are going to invest in these companies. They are going to invest in rapidly growing companies, normally equity type of an investment. They will also help the company in growing, and there will also be an active participation. Now, what are the characteristics of this venture capital financing? The characteristics is very simple. One, it will carry a lot of risk. There is going to be huge risk when a venture capital money comes in, or when a venture capital investor is investing in a company. Most of the times, their investment is for a longer period of time. It could be for 5 years, it could be for 10 years, it could be for 20 years. Liquidity may not be there. What is liquidity is they will not be in a position to sell their investment to someone else. I invested in a company. I am a venture capital fund. I invested in a company. I want to exit. Exiting will not be that easy. So long-term horizon, lack of liquidity, there's high risk. So it works on the principle of high risk and high return, and equity participation. Normally, the investments in the form of equity. Why we are doing investments in the form of equities? Because most of these rapidly growing companies could be loss making in nature. They do not have the ability to take debt as of now. So they cannot take up debt at this point of time. So because of that, they want equity to come in. So that equity will come from your venture capital partner. Next is, what are the advantages of bringing venture capital in the company? One, I get equity from them. Second, I think these are the set of people who have a lot of contacts in the industry. So they'll also be able to help me with getting certain orders, providing some operational assistance, guiding me through future in the company, providing me additional funding if needed. So they are set of people who will be able to help the company through the network of contacts. It injects long-term equity finance, which provides a solid capital base. He is more like a business partner who is going to share both the risk and reward. He will provide you practical advice and assistance to the company. Network of contacts are there. Additional rounds of funding can be done. Also, they can help you in exiting. That is, the venture capital would want to exit. That can also be done because they can help the company for IPO, initial public offer. Venture capitalists are experienced in the process of preparing a company for an IPO. They can also facilitate a trade sale. So venture capital partner does not only bring equity. Along with equity, he is also going to provide us a lot of contacts, a lot of advice, a lot of assistance, and future funding if needed. What are the stages of funding venture capital? I think there are some 6-7 stages of venture capital. Initial stages are extremely risky. Then the later stages, the risk level keeps going down. So you have seed money, which is extreme amount of risk. If you do 10 projects, seed money investment, 7 or 8 may also fail. So seed money, normally it is for 7 to 10 years. And for supporting a concept or an idea, extremely risky kind of an investment, high probability of failure. Next is the startup stage. In startup stage, some idea has come in and you have started developing a prototype, the risk is going down. First stage, you are now going to do production and sell it. Second stage, you want to expand further. Third stage, you want to expand further. Fourth stage, maybe for a public issue. So the risk level will keep going down as you go to later stages. But seed money is the extreme risk stage. Startup is very high. First stage high, then second stage sufficiently high, medium and low. The risk level will keep going down. Explain the venture capital investment process. Now, what is venture capital investment processes? What is the process the VC fund, the venture capital fund, is going to follow before they invest money in a company? Because if they want to invest money in a company, they are going to follow this process. Now, what is the process they are going to follow? First is deal organization. What is deal organization is, I want to raise this, I want to know which are the good companies in which investment can happen. The VC may directly identify them, or through some intermediaries they may identify them. The intermediary could be a firm of chartered accountants. So you are telling a firm of chartered accountants that we are trying to invest in a pharma company. So can you please give me some list of candidates where I can invest? So I can give my sector focus or business focus or promoter focus or turnover focus, so that based on that he will give me a list of candidates. Once the list of candidates are given, there is a screening process which is done internally. There is a committee which the venture capital fund will have. And if you have 10 candidates, out of the 10 candidates in the screening process, maybe 5-6 candidates are eliminated. So the screening is generally carried out by a committee consisting of senior level people of the VC. Once the screening happens, you will try to eliminate some of the companies, and then you will do due diligence. For due diligence, we need something called as an investment banker. So a lot of big fours do due diligence service. So a due diligence will happen. What is due diligence? Is doing the financial due diligence as well as legal due diligence, commercial due diligence, a lot of things, basically checking what are the possible things which can go wrong when you're investing in a company. So a due diligence exercise will happen. Verify the documents which have been given. Renowned consultants, that is your chartered accountants, firms can do it, or big fours can do it. After this, you will have to structure a deal. The deal has to be structured in such a manner that both the parties win it. There will be an equity investment along with some convertible instruments can also be there. Debt will be very low in a VC investment. After this, we will have to monitor the performance of the venture capital, the company in which the investment has happened. Check whether the performance is in line with what you had expected. If the performance is going in line, you may exit as per your original plan, or if the performance is not going in line, then you may have to see what is happening in the company, and sometimes you may take an exit even before. The VC nominates a nominee. The company has to adhere to certain guidelines like strong MIS, strong budgeting system, strong corporate governance. After this, what we'll have to do is an exit will happen. Exit will happen in two ways. One way is to sell it to the other parties, or you may also sell it to promoters of the company. At the end, an exit has to happen. Explain the structure of a venture capital fund in India. There are two structures. One is called a domestic structure. Second is called an offshore structure. What is domestic structure is, the fund is listed in India or is registered in India. It could be in the form of a trust or a limited liability partnership or a private limited company. The venture capital would be registered in India and would be investing in Indian companies. That is called domestic fund. So it could be a trust, it could be a company, it could be an LLP. It is usually structured as a domestic vehicle for the pooling of funds from the investor, and a separate investor advisor will carry those duties for asset management. In this case, what will happen is a domestic vehicle is used, that is, you're registered in India, investing in Indian companies. Offshore structure is where you are registered outside India. Offshore funds is one which is registered outside India. In that also you have two types of structure. One is called offshore structure and second is called unified structure. Unified structure is going to mix these two. How does it mix? You'll understand. In an offshore structure, the venture capital fund, which could be a trust, company or LLP, is registered or listed or incorporated outside India, normally in a place which is like a tax haven. That is, limited taxation is there. So to get the tax benefits, you will put the structure there and you will register it there, and from there it will make investments in India. It is going to make investments in India. Typically, the assets are managed by an offshore manager, while the investment advisor in India carries out the due diligence and they make investments directly into the Indian portfolio companies. What is unified structure is, again, it is a part of offshore fund, but in unified structure, what will happen is there is a company which is listed outside India. There's a trust which is in India. So it will invest in the trust. Some domestic investors will also invest in the trust. There's an outside investor who is there, which is registered outside India. They will be making their investment in the trust which is there in the India. Some domestic investors will also be investing in the trust in India. So a unified structure will be able to raise money from domestic investors as well as outside investors. Overseas investors pool their asset in an offshore vehicle that invest in a locally managed trust, whereas domestic investors directly contribute to the trust. So they are going to directly contribute to the trust. So there could be a domestic structure or there can be an offshore fund. Domestic fund is basically registered in India, investing in Indian company. Offshore fund is registered outside India, investing in Indian company. In an offshore structure, that's very simple. In a unified structure, that offshore fund is registered outside India, but will invest in a trust which is registered in India. Also, there are local investors who will invest in trust, and ultimately the investment will happen in Indian companies. From our point of view, it is going to happen in Indian companies. Explain the concept of bootstrapping. We have already explained what is bootstrapping. Bootstrapping is raising money from the personal sources of the promoter or from the operating revenues of the company. You are not trying to go for a bank loan. You are not trying to go for bank loan, or not going for some venture capital funding or an angel investment funding. Somehow you are trying to manage based on your available sources. Trade credit. Trade credit is basically getting the money from a supplier. That is, whenever I'm buying my product, if the promoter is well known in the marketplace, suppliers will be able to give credit. When a person is starting a business, suppliers are normally reluctant to give trade credit. But what can happen is, you can get credit if you are having a good financial plan or you have a good business, and also the owner of the company is well known in the marketplace. That is a possibility that can happen. Factoring is an arrangement where I am selling my receivables. I am selling my receivables. It could be with recourse basis, without recourse basis, with recourse and without recourses. In with recourse, bad debt risk continues to be there with the company. Without recourse, bad debt risk gets shifted. Also, when you do factoring, it can be on non-notification basis. What is non-notification basis is, customers will have no idea that there is a factor who is going to collect the money. This factor will act like an agent of the company and he'll keep raising the money. Leasing is another model. What is leasing is rent versus buying. Instead of buying a plant and machinery, I am going to go on rented mode. Why am I going on rented mode? Because I feel it is better for me to take the money on rent, or to take the asset on rent. So it is going to reduce the capital cost and also help the lessee to claim tax exemption. What is tax exemption? Is on the rent which you pay. If you do not have the money to buy a vehicle or a photocopy machine or a van or automobile, it is possible to take it on lease rather than going for one-time purchase and paying a huge amount. So bootstrapping is raising money from the personal sources without going for a bank loan. I do not want to go with a bank loan kind of a scenario. Okay, next question is, compare and contrast startups and entrepreneurship. Describe the priorities and challenges which startups in India are facing. Now we are comparing something called as a startup and entrepreneurship. Entrepreneurship is a broader term. It is a broader term. You can say startup is technically part of entrepreneurship. So startup is part of entrepreneurship. Entrepreneurship is a broader term. It includes the startup firm. Objective of a startup is very simple. It has an idea, conceptualize an idea and convert into a reality. What is entrepreneurship firm is, an entrepreneur is trying to attain opportunities with regard to the resources they have. A startup normally will not have any major financial motive as of now. It will not have a major financial motive. Entrepreneurship concerns mainly operate on financial motive. Now, what are the challenges which startups in India are facing? So, initially we said in India, startups are growing because of availability of talent, but still getting the right talent is very difficult. The main challenge with the startup form is getting the right talent. Most of the skilled people may not want to join a startup because one, these maybe they can be successful, they may fail. So there is a worry whether the startup would be able to do well. Also, the salaries which a startup can pay to highly skilled people may not be that feasible. So the main challenge with the startup firm is getting the right talent. Paucity of skilled workforce can hinder the chances of a startup's growth and development. Also, what happens is in India there are a lot of regulations which are there. So when you have to comply with all these regulations, there is an increase in cost which is happening, which will lead to late break even or delay in break even. Explain the term business model with the help of an example. Business model is very simple. The way in which a startup or any company is earning its revenues. So this is what the definition as per Investopedia. A business model is the way in which a company generates revenues and makes a profit from the company's operations. Now, I want to measure the effectiveness of the startup or efficiency or effectiveness of a business model. We can use the gross profit as the approach. Gross profit is a way to compare the efficiency and effectiveness of a business model. High gross margin indicates that the business model is more profitable, more efficient and effective. Let's take an example. There are two companies, company A and B. Both the companies are engaged in the business of renting movie. Prior to the advent of internet, both were doing physical renting. 5 crore revenue, 4 crore COGS, 1 crore gross profit. Before internet came in, all this was good. But once internet came in, you will have to alter your business model. After the introduction of internet, company A started to offer movies online instead of renting. This change affected the business model positively because revenue is still 5 crores, but the cost has gone down because in your online model, the cost of distribution is on the lower side. And because of this extra profit you make, you are having ability to now grow, invest in related businesses. So the business model has to continuously evolve. If it's not evolving based on the changes happening in the marketplace, it will lead to company going out of the business. Peer-to-peer lending and crowdfunding are same and traditional methods of funding. Do you agree? Justify your stand. They are not same type of funding. They are surely not same type of funding. In a peer-to-peer lending, group of people are coming together and lending money. Whereas in a crowdfunding, what is happening is you are raising small amount of capital from large number of people to finance a new business initiative. It could come in the form of debt, equity, and these are not traditional sources of funding. These are contemporary sources of finance for a startup. Concept of unicorn. Unicorn is basically one which has achieved a valuation of USD 1 billion. If you have achieved a valuation of USD 1 billion, you are called as a unicorn. It should be obviously a privately held startup rather than being listed or something. It should focus on something like new ideas, disruptive innovation, customer focus, high on technology. And if it is reducing its value below 1 billion, it will lose the status of unicorn. Beyond unicorn, we have something called as decacorn. Decacorn is something which has a valuation of USD 10 billion. Unicorn is USD 1 billion. Decacorn is USD 10 billion. Explain the meaning of succession planning. This is more related to not only startup, but related to any family managed business. Whenever you are doing a business, there should always be planning for succession because the promoters may have to exit or the startup founder may have to exit from startup at some point of time. Involves identifying the critical position within an organization and developing an action plans for individuals because I need some plan so that I will be able to find an alternate person in case there's an exit which is going to happen. It is crucial for all family owned businesses. The holistic approach ensures right people are available, and in case anything happens, there can be easily transfer from one person to another. This will also motivate all people, because it will act as a motivating factor for all employees in the company, because they will think that there is a possibility for them to move to a leadership role. Why should an organization plan for succession? One is risk mitigation. What is risk mitigation? Is suddenly the existing leader quits. Then if you make searches for a new leader, for example, Kotak Mahindra, the promoter recently made a exit. He is said that he is exiting. There are plans to have a new person, and as of now, another person is going to manage the bank. So there should always be a proper plan, so that when the existing leader quit, there is a new leader available in the company. If you do not have a leader, it will lead to disruption, uncertainty, conflict, and the existing leader has done some fraud, gross negligence, willful misconduct, but still you are not ready to move this person out. Why are you not moving this person out? Because you do not have anyone else to take care. So if you have some person to take care and you find this person doing any of this fraud activities or misconduct activities or a breach which has happened, you can remove that existing leader and put a new leader. Talent pipeline. This will act as a motivation. Succession planning keeps employees motivated and determined, as it can help them in obtaining more visibility around the career path expected. What is conflict resolution mechanism is, if you do the succession planning, there will be open and transparent communication and settlement of conflict. And in case of family owned businesses, succession planning will ensure that if there is a new leader who is going to come in and the existing leader is there, it will be able to align them with the culture, vision, direction and values of the business. Now, what are the steps in business succession strategy, or what are we going to do? First, I'll have to find out what are the key leadership positions which are there, CFO, CIO, what are the key leadership positions which are there. Find out what are the skill sets needed for these competencies, and identify if the existing workforce can fulfill these requirements. Map competencies required for above position. Identify competencies of the current workforce. Are the competencies there in the current workforce? If there are no competencies available, can you train them? If training is also not possible, then you may also think for an outside person. And you can also bring in something called a bridge leader. What is a bridge leader is, this person will help. There is a main promoter who is at 60 years of age. The next generation has to get into the business for 30 years, 25 years. They want to get into the business, but these people are not aware of all the things which are happening in the company. So what can happen is, a bridge leader can come into the company. He can manage the business when the main promoter wants to exit, and also prepare the young family members for leadership role. What are the challenges in implementing succession planning? Now, major thing is, one, this is the most important thing. Founders are the face of startup. Whatever startup is there, most of the time you will associate a startup with the founder. So if the founder is changing, there's a possibility that the way the startup is going to grow, the way the startup is going to execute its idea, it is going to ultimately change. Many times for a startup, it could be very early for them to implement business succession, because you will have to reach a mature stage, then only you'll be in a position to implement succession planning. Most of the startups are normally at early stage. They just have an idea. Now you cannot implement succession planning and say that the existing founder will move out and a new founder will come in. And also the founder's way of working and a corporate manager's way of working is different. So it is difficult for corporate leaders to work with founder or to work with that mindset. This also creates a challenge for succession planning. Let's just revise what we saw here. Initially, we started with the definition of a startup. The broad definition is 10 years, 100 crore of revenues, private limited company, partnership firm, or a limited liability partnership. It should not be created by any reconstruction or splitting up. innovation, development, deployment, technology, process, all that needs to be there. Major reasons for development of startup: government support is there, pool of talent is there, there's a cost-effective workforce, technology and internet is there, and variety of funding options. What are the variety of funding options? That is what we see in the next question. Multiple funding options are there. Either you take it from your personal sources, which is your personal sources, personal financing at the promoters end, or family and friends, or you go for something called as your peer-to-peer lending, or go through crowdfunding or micro loans, or you go through customer financing or vendor financing. Customer financing is factoring of accounts receivable, or you go through purchase order financing. Pitch presentation is basically a pitch which is being made. This pitch is a presentation which is made to the investors to make them interested in our company and to get an investment from them. I'll give an introduction of the team, what is the problem, what is the solution which is there, future projections which are going to be there, who are the competitors, what is the business model, and what have I raised any money in the past, the financing angle. What are the documents we prepare? What are the basic documents that are required to make a financial presentation? Income statement, your balance sheet, and cash flow statement. Modes of financing for startups: bootstrapping. Bootstrapping is basically raising money from your own sources. Angel investors. Angel investors are basically entrepreneurs, family and friends. Mostly these people invest in a lot of small startups. Venture capital fund is basically like a mutual fund which is going to invest in multiple companies. They're going to provide, they're going to invest in companies which have rapid growth expansion, rapidly growing companies. Explain venture capital financing. They are going to invest for a longer period. There is not going to be much liquidity in this. High risk is going to be there and equity participation is going to be there. Impact of bringing VC into a company: one, you get long-term finance. You get access to network of contacts. They can help you in doing an IPO. They can help you in facilitating a trade sale. They will also be able to guide the company, provide required guidance. Stages of funding of VC. There are 6 stages of funding: seed money, then startup, then the first stage, second stage, and third stage. Explain venture capital process. This will be deal origination. It is deal origination. That is, you can originate a deal or you can source a deal through the venture capital or through intermediaries. It is deal origination, not deal organization. Then you have to screen the deal. That is, the VC committee will screen whatever deals are there. Due diligence will be carried out for the selected companies through the screening. Deal structuring will happen. Post investment, a nominee will be there in the board of the company, and an exit would be done either through a sale to an outside party or through a sale to the promoter themselves. Structure of venture capital fund: it could be structured a trust or a company or an LLP. There's a domestic fund or there's an offshore fund. Domestic fund is registered in India, invest in Indian companies. Offshore fund registered outside India, invest in Indian companies. In offshore, there is something called as an offshore structure. There's a unified structure. In unified structure, the VC fund is registered outside India. They'll invest in a locally managed trust, and from there the investment will happen in Indian companies. Bootstrapping is raising money from your own sources. Trade credit, factoring or leasing, these are the options. Startup and entrepreneurship comparison: startup is part of entrepreneurship. Entrepreneurship is a broader concept. It will include a startup. Startup main focus is to conceptualize an idea and they do not have major financial motive. Entrepreneurs normally have a financial motive, that there are certain expectations from them. What are the challenges which are there? The challenges for a startup is getting the right talent. Also, they have to comply with a lot of regulations because of the cost go up. And the priority is to bring more and more startups into picture. You will have to do more and more smaller firms into existence. Business model is basically the way in which you earn revenues. The efficiency and effectiveness of a business model can be assessed through gross profit margin. Peer-to-peer lending and crowdfunding are not same. They are contemporary methods of financing. Peer-to-peer lending is you are lending each other. Crowdfunding is raising small amount of money from large number of investors. Unicorn is something which has achieved a valuation of USD 1 billion. It has to be a privately held startup. Decacorn is something which has got a value of USD 10 million. What is succession planning? Is planning for refilling the critical positions in the company in case an exit happens. This will help also in motivating the employees in the company, and you are also ensuring that right people are available for the jobs in case an event happens where the existing leader has to move. Why should you plan for succession planning? One, risk mitigation strategy if the existing leader wants to quit. Second, if the existing leader has done some fraud and you want to remove them. also to motivate your existing management, and aligning the idea of the company. Every company has their own way of working. Tatas have a way of working, Murgapas have a way of working. So different companies have a way of their working. Reliance has a way of working. So you want to align the new leader with the culture, vision, direction, values of the business. How are you going to implement business succession strategy? Identify the key leadership position. Identify what are the competencies needed. See whether the existing pipeline can meet it, or take the role of a bridge leader if needed. Challenges in implementing succession planning. Founders are considered to be the face of startup, so it is difficult to imagine a startup without the founder. Many a times it's premature for a startup to implement business succession, because you can implement business succession when you're a mature company. Most of the startups are at early growth stage, and the mindset of a founder is slightly different from the corporate mindset. So the corporate managers, the CFOs and the CXOs who are not from a promoter background or who are not an entrepreneur, they will find it difficult to adjust to what is the requirement of a startup or how the startup has to grow. With this, I'm kind of done. If there are doubts, you can just send me a message on that.